part of our break, we were discussing telecommuters, and the next type of what we call virtual worker that we're going to talk about are service providers. And so service provider is basically what we're just trying to classify and characterize as those people who try to work for more than one, what we call customer or employer at a time. Okay? And again, we like to use ourselves as a classic example of service providers because we're trying to offer our services to multiple traditional tests of employment status of independent contractor versus employee board to actually be a legitimate independent contractor. Otherwise, the subcontractor, I'm getting painting contractor, an electrical contractor, drywaller, is a default W-2. I'm not sure if it's different here in Arizona, but that's the rule in California in regards to subcontractors on construction projects. Okay, so now as we're talking about in terms of today's what we call the sharing economy, gig economy, our classic example of Uber and Lyft and all these independent people out there, it kind of almost begs the question, are they really employees or are they independent contractors? What are your thoughts?
I think they're employees.
You think employees? Independent contractors? It's kind of one of those real large gray areas where we don't know, right? Because let's think about it for a moment. Uber doesn't own vehicles. They do own some, but for the most part, they've been able to build up because people use their own vehicles, right? Have I ever seen an Uber uniform? They all wear their own street garb, right? And the only thing that I know that it's an actual Uber driver is because they put some decal up there in their windshield, right? Now, there's no shift, is there? You kind of turn yourself on, turn yourself off, make yourself available. Theoretically speaking, the driver could do a couple rides and call it a day, right? Or I could work around the clock. There's no break. There's no lunch break. There's no 8-hour shift. It's just kind of on and off, on and off. And that's kind of in terms of challenges, what I'm getting at is that from a lot of perspectives, must be an employee. But from other perspectives, all the wear and tear is theirs. They're providing their own vehicles. They're not told how to dress or what to wear. Because when I went to go to my rental car, I saw people Hertz, uniforms, name badges. I had a Hertz facility. I knew I was talking to Hertz people. But my Uber driver, the only thing I know is Uber is because the sign on the windshield said Uber. But if they came out, I wouldn't know who they are. I'd think that they're trying to kidnap me, right? And it's an app, which is on the phone. And so this is kind of where we get into this, wishy-washy area where each state may end up taking its own interpretation. And then again, do we have some sort of federal legislation? But doesn't that make sense? Is that you can have a large number of states, that's an independent contractor, and then you can have states that says, well, it's unfair. I see your point, but, to truly, in terms of the fact that they have to incur so much burden, what we call the wear and tear on their vehicles. They're driving around. They're working at all kinds of, in terms of hours. There has to be some sort of what they call from the employee's perspective, whether it's fairness, that could be the point of view, and thus states may interpret it as they should be employees. And we had what was an interesting case was in California. A lot of times when people question their status, they go to the state employment labor board, right? And they usually petition a case. Now the case wasn't in terms of law where it's casting for all employers. It was determined in terms of the case. And the case that we had last year in California was that a lady who drove for a few months on Uber was essentially just trying to claim I should be entitled to some overtime. Okay? That's one part of the case. Because as part of being an employee is this whole idea of your regular wage overtime. But the biggest issue really is the wear and tear. You know, that you're entitled in terms of in those reimbursements. And so the labor board did decide in the favor of the driver, but the key takeaway was this wasn't an actual ruling for all Uber drivers. This was just in terms of an isolated case. But the point in terms of the takeaway is these are the ramifications, because if I'm an employee versus I'm an independent contractor, an employee, I may potentially qualify for health benefits. I may also be entitled to some overtime, right? I'm driving at all kinds of hours. But most importantly is the wear and tear. Now, yes, question in the back.
There's going to be another problem if they're classified as employees, potentially, because we can't claim unreimbursed employee expenses are now disallowed.
Yeah, Form 2106 has gone by the wayside, right?
We're seeing most about this, you know, in some of the traditional formats, the way there's employees who still have to pay a lot of their own stuff. I think it's financial planning, realtors, that kind of thing.
Right.
This is going to be a big issue.
Yes, it is, and that's an important point. You have a question?
I have another question. What about the liability issue? If there was a car accident, is that an Uber, or if the driver got hijacked?
Well, apparently we've had a number of cases that you've seen that have been in the media about there have been passengers who got kidnapped. There are a few in terms of drivers that engage in certain crime sprees. And Uber and Lyft and these companies were not able to absolve themselves of liability. They were found liable in those cases that have come out. And so this whole kind of relationship of independent contractor employee has not absolved them of third-party liability from what's happened in terms of, you know, various crime or acts that's been, you know, occurred on behalf of their drivers.
So then whose responsibility would be like for the automobile insurance, or business, or they have to have some kind of business liability insurance, I would think.
Well, in the reality of the cases that's been happening, it's been both parties. Yeah, so obviously, you know, the driver involved in an accident or whatever, let's just say calamity that occurs, but also it's falling back in terms of the Uber. But what they've responded also to is providing a blanket umbrella coverage too. Because the reality is also, people are operating off of their private automobile insurance policies, and lo and behold, they'll find out that they don't have coverage because it's being used in a commercial purpose. And that's not the purpose of your private automobile insurance. So they are offering it in terms of that coverage. Now, getting back as in terms of the lady in the back, this is a huge point right now. Under the Tax Cuts Jobs Act, that's just recently come out, that a lot of us are going to be getting, you know, CPE on, and one of the big areas is, and obviously was the huge selling point of the bill, is let's raise the standard deduction so that people don't have to do all these deductions, thus pay us, okay, to do a return with a Schedule A, and it kind of makes it easier. Well, it's a little bit kind of, you know, as we know in terms of in the clients who typically in terms of in benefiting those, it might be, you know, extremely disadvantageous. Because as I think in terms of, you know, from the clients that I've dealt with, is that you have lots of clients out there, especially tradespeople, people who are in sales and different types of occupations, that their companies don't reimburse them at all. And they use their car, they travel overnight, they work from home, right? And all these deductions are gone. I mean, they raised the exemption limit for the alternative minimum tax, which would have been nice, but they eliminated all these deductions. And this is what people, as they're starting to kind of understand, and it's disseminating down what it means to them. Because a lot of people are focused on the elimination of state and local income taxes, and they're kind of trying to, basically pick us out from the crowd being out in California. But I can't help it if our median property values are $1 million. It just happens people like our beaches and our property values gone up. It's not, in terms of my fault. But, that's the headline that people look at. But around it is all those different occupations that we're working with is like the airline pilots, the stewardesses, the tradespeople, the salespeople, all these people who had out-of-pocket, unreimbursed expenses, and they were quite large. And in addition, I had lots of people who paid financial advisors. They paid us. They had all these additional miscellaneous type of expenses and deductions in addition to that. So what got caught in the news was just the limitation of state and local income taxes, but it's really all the other kind of what we call deductions, what we call miscellaneous, that went by the wayside. Now, given the fact that we have in this federal law that has eliminated these deductions, it doesn't mean that it's also going to change any trend. Because in addition to tax benefits, the primary issue that's going to be at stake, and this is going to happen state by state, is going to be, what we call health and welfare of workers. Do I have the right to workers' comp if I get injured in an accident, I got into a car crash driving as an Uber driver. Should I be on workers' comp, or is that my medical insurance? If I work and grind and pick up people from bars and I pick them up from ball games, should I get overtime? Or should I have any minimum wage? Should I be eligible for health insurance? Those will be the fundamental issues that will be determined in state by state. And so far right now we've got various cases and litigation that are working their way through the courts for both Uber and Lyft, and essentially we're waiting to see kind of how it shakes out. Will they become W-2 employees? Will they become 1099 independent contractors? Most likely, they'll eventually become W-2 employees because of those reasons. The challenges that we have is because our employment laws and our tax laws, we only created this either or. An independent contractor or W-2 employee. We didn't create some sort of, hybrid type of role. Also, here's what you might see. I've seen these pop up every few years where businesses try to get creative with their workers. And I don't know if you've ever encountered this, where they basically state, you're the salespeople. You guys are going to go out and form your own LLC or corporation, and then I'm going to hire you right back. And I've seen these kind of devices come up as a means to work around and skirt the laws. Again, the whole purpose is to avoid paying benefits, overtime, as well as payroll taxes and workers' comp. The whole question is whether at the end these will be lawful or not. Because there is a whole legal concept of what we call an alter ego. And is anyone familiar with an alter ego? No? Well, the alter ego is the concept if you're dealing with an auditor like from the IRS and you're saying, no, that's not Mr. Jones' individual 1040 taxpayer. That's the XYZ corporation. And then the auditor is basically saying, no, that's an alter ego of the individual. He goes, what do you mean? It's not a legitimate separate business. I don't see wages. I don't see employment agreement. I don't see minutes. I don't see resolutions. I don't see the actions or operations of an actual real business. I just see a personal checkbook. I see, as I'm looking through the bookkeeping and the records and check register, I see payments to daycare facilities. I see the grocery stores. I see the mortgage. In other words, you're just operating it as though it's one and the same. Thus, I'm going to set it aside. They call it an alter ego. Setting aside the corporation. So again, there is quite possibly that this will be the same argument that will be used for many of these employment relationships that are devised. That all they are is just an alter ego of the worker, and thus should be set aside. So outsourcing providers is our final type of what we call virtual worker, and those are typically the companies that ship our products, we buy our software from, we buy on the web, do payroll, so on and so forth. Many small businesses engage in outsourcing. You may do all the bookkeeping, bill paying on behalf of your clients. That's a form of outsourcing. This has been a long-term trend that in business is that they are stripping away more and more what we call the day-to-day functions of what they do. I see a huge growing trend out there of businesses that engage. They don't want to pay their bills. They want to outsource it to an accounting firm. They want them to do billing and follow-up. They want them to run payroll and so on and so forth. Outsourcing is more of a long-term trend. I've even seen it in terms of in our business. You've probably gotten solicitations where firms will do the tax returns for you. You outsource in terms of to them, and they'll do bookkeeping and so on and so forth. So in all different facets, you're seeing outsourcing working its way through. Okay. So that kind of brings us up in terms of in the need of some sort of what we call a safe harbor independent contractor, because the theme that we're seeing here is that we have many alternative forms of work, or for lack of a better term, employment relationships, right? But our laws of where we're at in terms of today are not based upon the ease of an on-demand economy. It's like, for example, I could immediately sign up and be an Uber driver and not necessarily go through a background check and fill out an application. I could be up and driving within probably half an hour. That's how easy. And then I can do a ride and I can turn it on. And then I can take a week off or a month off and turn it on back again. The challenge is that in our overall society, it just kind of doesn't work because it's not necessarily beneficial and nor in, everyone's interest to have a large population of people who are self-employed doing estimated taxes, right? Because essentially, if we turn the entire workforce over to being self-employed, how many people are going to be in back taxes and never pay? So thus, the whole point is you need to have some sort of withholding. That's what it's really at. But the compromise is also the company should incur somewhat of the burden of the FICA taxes. It's not fair to shift all of it to the worker. But part of the arrangement is, because you're getting yourself involved in this, you're not going to qualify for the traditional benefits because you're what's called an occasional type of worker unless you've met some sort of a threshold. So I believe and I think that there should be some sort of framework so that we eliminate the uncertainty. The challenge is, yes, Thomas?
Well, the other thing that would be added to that is where expenses or costs are a material part of that person's operation, like the Uber driver or whatever, that they get the same kind of treatment as, say, a statutory employee.
Right.
Where they're able to deduct on Schedule C in addition to those items.
Right, and that's a valid point that you're bringing up, because let's suppose that this class of drivers is all treated as W-2s and they don't get the same treatment as a statutory employee. They're going to miss out on those deductions, right, and they will be disadvantaged. And so that's why, as I suggest here, there has to be some sort of what we call a safe harbor or a rule of the road created. And when we get down terms of the actual record keeping, the technology's there that Uber can at least calculate what the standard mileage rate is and automatically do the calculations. So if the driver wants to take other, ordinary necessary expenses, that's up to them. But really what we call is the directly related expense of operating the trip, they can default in terms of to the standard mileage method. I mean, our tax code's full of allowances, right? We got per diem allowances. We got now home office allowance, right? We've got vehicle allowance. It's all designed to make it easy.
I've got an NBA referee, who's an employee of the NBA.
Okay.
Who spends about $50,000 to $70,000 a year on travel expenses.
Right.
So, I mean, it's ridiculous that he doesn't get to deduct it.
Right. But like in terms of in his case as a referee, because we have per diem allowances and we have standard mileage rates, we make it easy to account for what those expenses are versus him keeping in terms of all the actual expenses from city to city.
Although they're collectively bargained benefits, they make money on those things, so they're a little bit reluctant to go to the allowance.
Correct.
Anyway.
Yeah. Okay. So as we've talked about in terms of in virtual workers, now we're getting into an interesting issue is workers who can work from other states and other countries, right? And potential payroll issues. So when I talk about, telecommuting taxes, some states use what's called the convenience of the employer rule. And so what that means is that the worker is subject to tax on his or home income in the home state of the employer. For those states that use the convenience of the employer rule. What do you mean? I'm here, I'm living with my family, I'm out enjoying, Sedona, Arizona, but, the company happens to be based back in Massachusetts. That's the idea. It's for the convenience of the employer. You're a Massachusetts employee even though you're living and working in Arizona. That's the concept of convenience of the employer rule. Okay? Currently, Delaware, Nebraska, New York, and Pennsylvania subscribe to that convenience of the employer rule. Okay? So this is kind of a new emerging area where states could essentially be saying that all those out-of-state workers telecommuting actually owe us income taxes as well because your employer is based in our state. That's what it means. Okay? New York is the only state right now who's trying to enforce it aggressively. A lot of times is, like for example, as Thomas was bringing up, in the area of sports, entertainment, those are your classic most notoriety examples of multi-state employment. But tech companies, lots of companies and businesses right now, it's becoming more and more commonplace to have basically a virtual payroll, where that company may be based and headquartered in Silicon Valley, but our workforce is all over. Utah, Colorado, Arizona, so on and so forth. And so this is why it's one of these that you kind of have to keep in terms of in your radar screen, and this is what it means. Okay. So when we talk about the multi-state tax issues in terms of employers, maintaining an employee in another state automatically creates a nexus. Automatically. So therefore, the company, as a result, will also be subject to the income, sales, and use tax, as well as property taxes in that state. So, if we didn't have the convenience of the employer rule, and we're hiring workers who work full-time on our payroll, right? And they're all W-2, I should be registering as an employer in that state. Well, by virtue of doing that, I have a nexus in that state. And all the taxes that we spoke about earlier in the morning, I have to allocate for that state. Even though all I have is just a worker who is answering emails, who is asking questions, answering questions, what we call like a help desk, or scheduling shipments, customer service, or might have just been doing accounting and billing, right? That's the significance of that. Okay? When we have a multi-state type of situation. And it's not unusual in businesses nowadays to go out to the web, like we talked about Uber and Lyft. Guess what? There are plenty of sites out there where you can hire freelancers to do a website, to do a business card, to actually might do accounting, bookkeeping. Could be also doing programming for software. We have Odesk, Elance, Upwork are some of the predominant ones. And it's also not unusual that you're hiring them from another country. And that you basically, just like Uber and Lyft, you're going via an app. So let's talk about the types of overseas workers. All right. So we're going to talk about expatriates and we're going to talk about foreign nationals. One of the things I want to clarify about an expatriate, when you hear the term expatriate from the IRS, it means someone who's renounced their U.S. citizenship. Okay? So keep that in mind. When a business or a corporation, multinational corporation, says the term expatriate, it means a citizen who's living and working in another country on assignment and coming back home. And why I say that is because you have to know how the term is being used. Okay? Because the IRS, the term expatriate is there are people who renounce their citizenship to get out of U.S. tax filing obligations. Okay? But in the world of global business, expatriates are those who work for years in another country and come back. Okay? Foreign nationals are those who are what we call, in a sense, non-resident aliens who you've hired in that country for U.S. tax purposes. So the U.S. expatriate person who's working for Hewlett-Packard, who's working for General Electric in China, in South America and Europe, is typically a W-2 employee. So when you have, in terms of the foreign nationals that are hired in payroll, the time when they're subject to backup withholding for U.S. purposes is only when their income is effectively connected to the United States. Okay? So with today's virtual world, it's very easy to have foreign workers. I know as much as the immigration debate focuses on people physically here, but today's work, it happens globally and virtually. But for our U.S., this is federal, is only one that's kind of connected here. And our federal rules is more physical as opposed to virtual. Because everything we talked about earlier this morning was about states essentially evolving the definition of physical presence. But federally speaking, it's still more in the traditional. When they use the term effectively connected, means you're actually here. Okay? That's the point. So the foreign national's income is deemed effectively connected when the services are performed in the U.S. So a lot of the programming that goes on when you're hiring programmers in China and India and overseas, they're doing it all overseas. They're not flying into here. They're not coming into the company, getting on their computer system and creating the code. They're all doing it overseas. So thus it's not effectively connected. Does that make sense? So you see this federal distinction where it's not involved and is kept up in terms of in that definition of global commerce? So IRS Pub, just for your information, 515 and 519 will give you more information in terms of in that backup withholding. And when you deem that you do have a foreign worker who's subject to backup withholding, you're going to use the Form W-8 series. Because I get a lot of questions is, do they need to have a Social Security number? Well, they're not able to work in the U.S., so they're not going to have a Social Security number. Do they need to have an ITIN number? You only need to get an ITIN number when you file U.S. tax returns. Because you can do backup withholding, they just don't file. That's the point of backup withholding. Okay? And so in terms of in that case, when you do the backup withholding is that you've determined that it's effectively connected in the United States. Okay. Any questions on virtual work before we move on? Yes, ma'am.
When this security connected business, okay, suppose we have a computer and we have bookkeeping working in the United States, but a foreign person is working from their home to do the work. What is the service done here in the United States or in the other countries?
Okay, so the bookkeeping firm here in Phoenix is hiring a company in Shanghai to do data entry, reconcile bank accounts, maybe process payroll, okay? And they're doing that part of services. The bookkeeping firm in Phoenix is billing the client, meeting with the client, obtaining the source documents, and they send it to bookkeepers in China. So as we're talking employment, the bookkeeping firm is hiring Chinese bookkeepers. They're not in the U.S. performing any services, so there's no backup withholding on that, on those payments.
Okay, but the service may be done in the computer in the United States online.
The service for the...
For example, if I have a QuickBooks,
Right.
and they can remote in to do the work.
Correct.
So they still, the service is in that country.
For employment purposes, correct. Yeah. Yeah, that's essentially is the point, is that when we're talking employment, they are not effectively connected to here doing the work. They're in China.
But actual work is performed inside a computer, remote in from different locations.
It's a service.
Okay.
Service has different elements of the work being done. Yeah. And this is a huge aspect, is a lot of work being done nowadays are services. And the fact that those services that can be done globally. So what you're talking about, part of the service is done here locally. But a lot of what, let's say the back office data entry is being done offshore. That part that's done offshore is done offshore, and it's not effectively connected here. So I would not backup withhold to those workers for their portion of the work or that they're billing here to the United States. Okay? Any other question? Okay. So let's move on and talk about the third pillar of our virtual world, virtual investing. Okay? So we talked about virtual commerce, and we talked about virtual work. And this is kind of the natural evolution of how more and more we become like this virtual world. Kind of like that movie, what was it, Arnold Schwarzenegger, Total Recall, right? Where you eventually get a world that's made up in your mind of virtual reality. Okay? So we talk about, and we're going to spend a lot of time talking about crowdfunding. Before we get to crowdfunding, we're going to talk about kind of its early birth is peer-to-peer lending. Okay? And how many of you here you know, in the years that you've been in practice, you've had clients who are as investors that they would do what's called a hard money loan. In other words, they would be the investor, and they would, instead of that person who bought the property went to Wells Fargo, your client was essentially mortgage. Anyone ever have that? Yes? Okay? That's peer-to-peer. One person to one borrower, right? Okay? So when we think about in terms of in those times, the only people who did that were people who had a lot of money and, you know, the time in administering it, because an amortization schedule, collecting payments, you know, 1099 at year end, going through that hassle, and then making sure that they're paying on time, and if there are credit issues, so on and so forth. So you had what we call a small group of people who would engage in that. What technology has allowed is now as we're getting down to small investors and masses to basically do that same thing. So that if I have $500 or $1,000 to invest, a small amount, that they take a pool of people and go and give the loan to the person obtaining the mortgage. You with me there? So that's what these peer-to-peer lenders, like Lending Club, SoFi Mortgage, are doing. They're just opening up to the masses to contribute your small amount, and they pool together to lend to an individual borrower. Student loan, car loan, personal loans, mortgages, so on and so forth. Okay? Now, a lot of people wonder is, why would they want to do that? Why would you want to go and invest in that? Why would someone want to borrow in terms of in that way? Well, a lot of times, you know, people, they've reported in terms of their experience, they don't like using the traditional banks. They don't like, in terms of the experience, the way that they're made to be felt. Also, they feel that it's very impersonal. It could be also in terms of their underwriting standards. And then also, finally, it could be cost. And then on the flip side, those who are lending out their money, why would you want to go and take in those risks? They're trying to do in terms of noble purpose. They want to try and find a way that they can earn a higher return, because traditional interest income earning investments have been low for so long. So you kind of you see all these factors of the offshoots and evolution of people using social media, being comfortable with e-commerce. Eventually, people are going to use it as a tool and a platform for investing and lending money. Okay? Yes?
Is Cabbage one of those?
Cabbage is not what's called a peer-to-peer. They're just an alternative lender.
It is alternative?
Yeah, they use traditional money sources. They're just alternative in the way they underwrite the loan. Okay? But Cabbage, like a lot of these newer companies coming out, try to do what's called a merchant-based loan, meaning that you accept credit cards in your business. So instead of you making a monthly payment, we're going to debit a certain amount from your credit card receipts on a daily basis. So that's what Cabbage is doing. But a true peer-to-peer lender is people like us giving our money to Cabbage, and then Cabbage is using that pool of money to give loans. But Cabbage is really just using the traditional money sources. Okay? So let's talk about the taxation of peer-to-peer lending. Fairly easy, straightforward, what we've been accustomed to. Investors will be receiving 1099 INT for their interest from Lending Club. Borrowers, on the other hand, must use interest tracing rules to determine the tax deductibility of their interest payments. And with the Tax Cuts Jobs Act, we're limited on what we call home equity interest, right? Not only have we taken a haircut from $1 million to $750,000, we no longer have second mortgages and home equity lines of credit. It has to be essentially what we call acquisition debt. Okay? So just to keep in mind. So therefore, in terms of in the only space out there, because miscellaneous deductions have been eliminated, like investment interest expense, you're only going to have business interest. Okay? So you're going to have traditional mortgage interest for what is called your acquisition debt, and then you're going to have business interest when we talk about interest tracing. I believe, and correct me if I'm wrong, I think we still have student loan interest under the new law. I believe it's still there as an adjustment to income. So there are student loan products out there, and so you'll still have in terms of the student loan interest deduction. Okay. So peer-to-peer lending is kind of what we call that early, the early form of crowdfunding. What kind of gave birth and opened up the floodgates to crowdfunding that we've been hearing now was back in 2012 we had the Jumpstart Our Business Act, known as the Jobs Act, that was signed into law. Okay? And the purpose of the law was to essentially streamline regulations for how to encourage small businesses to raise capital publicly. So when we think about a lot of IPOs and public offerings, that is inherently a process that is full of a lot of regulation and filings behind it. And so that has always been the sole domain of very large companies. It's extremely cost prohibitive, so thus small businesses have only, for the most part, been able to rely on essentially what we call friends and family, going to banks and borrowing money, or getting individual, private, or angel type of investors, until we had crowdfunding. And so crowdfunding from the Jobs Act created a pathway to essentially streamline for small businesses a way to solicit capital from the masses. And that was the purpose of the legislation. So in this Jobs Act, we had 3 types of crowdfunding that were created. We have donation-based, reward-based, and equity and debt-based. Okay? A donation-based type of crowdfunding means that I'm contributing money to this offering, and it's a gift. I get nothing in return. I just believe in it. That's what I mean by as a donation. A reward-based, there's some sort of enticement behind it. So let's suppose that a new business is starting here in town, and they're going to create some sort of innovative kind of addiction rehab center, and they need to raise some money. And they're asking for solicitations as part of the crowdfunding for the public at large to contribute. And as a result, we are going to give you $500 worth of health spa benefits. That's the enticement. If it was a donation, it's because I'm putting up the campaign. We want you to believe in it. We're doing noble good, so on and so forth, but you get nothing in return. The reward base is that there's some sort of offer behind it. Okay? So that's the distinction. The final, when we talk about equity and debt base, is the most typical. I'm either loaning you money, which is going to get paid back, or I own a piece of your company. So those are your typical 3 pathways. Okay? You with me so far? Fairly straightforward. So let's talk about personal fundraising. The most prominent example is GoFundMe. Okay? And on GoFundMe, it is a site used for personal campaigns that you have those who lack money for school, or they're going to have a wedding, family's gone through a disaster, so on and so forth, community, your home may have been ravished by a fire, a flood, whatever that it is, there isn't a limit in terms of for those people who put up a campaign and solicit to the masses to donate it to it. Okay? So here we have, in terms of in the case that, this, lovely lady who needs money to go to school, and she puts up in a campaign, and she raised $95,000 to go to Harvard. Okay? And she was extremely successful in doing that. And there are people who are successful at raising enormous sums of money. So the point, what you want to know about GoFundMe is that this is a pure example of donation. That those people who gave to this lady for her campaign got nothing in return. They believed in it, they wanted it to do good, and they helped her. Okay? So we're going to now talk about taxation because we're tax practitioners and this is the part that we're interested in. Okay? So let's talk about the tax treatment of contributions. So for a donor can give up to, it's actually been raised as a result of the new law. I hadn't updated that. But the point is, for the recipient, it's not income because it's a gift per Code Section 102. Okay? So when we step back and think for a minute here, it's quite possible I can receive a large sum of money tax-free. Okay? Most donors are really not going to hit the gift limit for filing a gift tax return, or Form 709. They're usually in the form of small donations of a few $100s at a time. So it's really what we talk in terms of in the recipient. Okay? However, a number of these sites, because of the sum of money, so like, for example, here, as she got $95,000, GoFundMe would issue her a 1099-K for that money. Okay? So in terms of, in dealing with this, as I've been stating, this money should not be taxable. However, she got a 1099. So what do we do? What would you do?
Put it on, take it off.
Huh? In and out on line 21? Ignore it? Huh?
Record it and then deduct it off.
Right, but where? What do we do? We want to work through in terms of mechanics.
Yeah,
Line 21, okay? So we want to, the suggestion is as Ruth and Thomas and a lot of the group is saying, is we want to report it as what we call other income, is line 21. And then what we want to do is on a line just immediately below, we want to report the deduction. So that in terms of in our software, that you're not putting in what we'd call a zero, that you've reported it on two lines. Okay? So we have the line that shows the amount of income and then the line that's shown in a negative amount. And what I would suggest in terms of in the second line is income excludable pursuant to Code Section 102. Okay? Now, let's talk about charitable contributions. So then that's the other area or where you're going to get a lot of questions is, as I'm donating money to causes, when and if ever are any of these contributions actual charitable contributions? And under the new Tax Cuts Jobs Act of 2017, we still have deductible charitable contributions. So under GoFundMe, in order for a contribution to be considered deductible, it must be made to what's called a GoFundMe certified charity campaign. How do we know that an actual campaign that I'm donating to is a GoFundMe certified campaign? There's going to be a little badge like this that exists in the listing. Okay? So what the badge is essentially telling you is that GoFundMe, the operator, has vetted the campaign that it's actually a bona fide 501c3. They've done the due diligence on your behalf. So therefore, you can count on with certainty and the assurance that you've given to actually a charity in this campaign. Okay? So like if we go back in terms of to this campaign, we don't have a badge here. It seems like we're donating for a charitable purpose. We're just giving away gratuitously. But when we have here, and we see a badge, maybe I was donating to a scholarship fund. But that's the key. is that it will say in the listing and prominent that it's a certified charity campaign in order for my contribution to be deducted. Okay? All right. Yes?
Question on the charity. What if you know that it's a charity, but they didn't get certified? But what if you know that it is?
Yeah, so the purpose of the badge is that the operator GoFundMe did the due diligence for you. So let's suppose, and many of us work with nonprofits that tend to be a bit lax. They don't have it together, right? And they are trying to participate in this form of fundraising. Well, as tax practitioners, that hasn't swayed us from taking the deduction. We're just trying to state how to prevail, right? And so we may lack some elements of substantiation. But what I would state as a practitioner, I've got proof of payment. If I can show some sort of element, let's take, for example, a local charity that happens to be on GoFundMe, and I can prove that they're an actual 501c3. Well, how do I prove a 501c3? Huh? IRS has a website of exempt organizations that you can go and it shows the status. So you can pull that up. And if you search it,
Arizona also has one of those that you have to apply in.
right, like for example from the State Attorney General's office, or they have a registry. Some states that it's managed by the State Attorney General's office. Others have a registry of charitable Department of Revenue? Okay, so if you go up to the registry in the database, these are all methods, again, to prove your point. It is a charity. I have proof of payment, thus it's deductible. So the answer is, as long as I can prove those two elements, I've got a deductible charitable contribution. What the badge is doing here is just trying to do the due diligence for you. Okay?
Why not just attribute to the charity?
Well, it's about masses, because it's like, for example, let's use the collection plate example. A lot of people who go to church, it might be a small group of people, but you may have a larger group of parishioners who just don't go to Mass every Sunday, but they're still involved in the organization. As well as you have those who just might believe in the cause. So it's just bringing it to a wider audience. That's all. That's why they end up doing it. Collection plates have existed for the longest time. How many times did a Little League team, Pop Warner team says, we're going to Williamsport, we need to raise some money to pay for the boys to stay in the hotel and travel, right? And you only have that small group of parents. But with these sites, now we can open it up, and believe it or not, people who don't know you and are strangers, they are generous enough, they're actually donating to it. That's just what's happening. As well as you may have people from your Facebook and your social media, your wider audience as well. So that's the reason, is in terms of the rationale, you can bring it to a larger audience. So let's talk about funding for a business or a project. It's inevitable that as we have crowdfunding, that we're going to have those who are going to be inspired to going into business or as a means of raising capital for business. As we spent much of this time talking about is what we call social type of purposes or charitable, nonprofit type of works. But in terms of in the business area, there have been sites like Indiegogo, Kickstarter, which are geared for those who are going into business. They want to raise money for a new invention. They want to start up a new store, go into a sideline, buy a piece of equipment. It's just another alternative means of raising capital that is now made available. So as I grew up with Sesame Street and Reading Rainbow, here's Lamar Edwards. And in terms of, he had a campaign to bring Reading Rainbow out there, and they raised $5.4 million for this campaign. When it says backers, it means that the $5.4 million is made up of 105,000 individual people. That's how they got the $5.4 million. See, technology, social media shows the power of what we call the small contribution, of how it can grow to something large. And that's what these allow and facilitate, that I can bring it out to a large audience and raise a large sum of money. Okay? So how does it work? A person who creates the campaign is called the creator. So here's the creator. Reading Rainbow wants to bring, in terms of to those people, to those kids in schools of low income who lack access to what we call iPads and tablets and have access to these e-books. And so that is the creator. The creator establishes a goal. Okay? The goal here was $1 million. They eclipsed the goal fivefold. But that's what you try to do. You try to establish a goal. A person who pledges money to the campaign is called the backer. Okay? And as you saw in Reading Rainbow, there was 105,000 separate backers. As I stated earlier, like in the lady who's going to Harvard, that was purely donation-based. Other campaigns offer rewards. So like in Reading Rainbow's case, they could be offering you a free subscription to their subscription service of Reading Rainbow. That's an enticement. Okay? So Kickstarter is the #1 site out there for those who are trying to raise money for business purposes and projects like this. So when we look in terms of the numbers, there so far have been about $2.5 billion that have been pledged on Kickstarter thus far, which equates to 109,000 separate campaigns. And 31,679,000 pledges, and that's just about 11.25 million total backers. So that's when you kind of think about it in terms of scales and numbers, when you look at the power of small donations and the power of the masses of how big something can be in a short period of time. Okay? So let's talk about the taxation of this. So right now we don't have any regulations or any laws. All that we have at the moment was essentially an information memorandum from the IRS Office of Chief Counsel that came out in 2016. So the IRS Office of Chief Counsel essentially had drafted the memorandum that just basically articulates what is going to be their general point of view. But it's not law, it's just essentially giving in terms of their perspective of the way these crowdfunding ought to be treated. So they basically had stated that the IRS's position will be that, generally speaking, crowdfunding will be deemed as income in accordance to Code Section 61, unless it can be proven otherwise. So Code Section 61 is one of the basic principles that we learn in taxation, that all forms of gross income are taxable unless there's an exception to the rule. So unless it can be proven that it's a gift, a capital contribution, or a loan to be repaid. That's kind of what we call the general position. Now, as we talked about earlier in the GoFundMe, is that if someone is in need of a medical operation and they're trying to raise money for basically an organ transplant, and people believe in the campaign and they're giving out of the kindness of their heart, that's a donation-based campaign, right? Nothing's given in return. But if I say to the people that if you give to me in my business that I own, let's say that I'm a auto garage, that I will give you free tune-ups, but you're helping my wife who's in need of a transplant, that's a quid pro quo. Okay? If we're essentially saying in terms of in the campaign that I'm soliciting money for my business, but you'll get a piece of the business, that's a capital contribution. If I'm soliciting money for my business, but I'm going to pay you back, that's a loan. So that's essentially is what we call is in terms of the hierarchy that we would have to go and look at. So therefore, the key denominator here is there some sort of quid pro quo? Is it really a gift? So when we think about in terms of in the rules of gifts, we go back to the tax court case of Duberstein from 1960, that a gift is truly an amount that is transferred out of a detached and disinterested, what we call active generosity. What we think is the quid pro quo. That if I'm getting something out of the kindness of my heart, I'm not getting anything in return. That is the pure example of a gift. Okay? And that's what we're kind of looking in terms of in those elements. And when we look at, like, for example, GoFundMe compared to other sites like a Kickstarter, GoFundMe is a purely donation site because it's focused and geared towards those who are individuals who have a personal need. We're raising money for a wedding, we're raising money for a personal disaster, medical need, school, I lost my job, can you help me out? We call those personal type of issues. Kickstarter, on the other hand, is intended for those who are trying to go into some sort of business type of motive. Okay? I have a new invention, I want to start up a business, I've got some sort of idea, I need to fund a technology, I need to buy equipment, so on and so forth. Those are the distinctions in terms of in those type of sites. So usually, if you're encountering those who are GoFundMe, those are almost always donation-based. And if you have those who are coming in and saying, look, we raised an amount of money, my daughter is, has a leukemia, or we raised some money to help with her chemotherapy and some of the new alternative treatment, and we had this GoFundMe, that shouldn't be taxable, okay? But if they were, like for example, on Kickstarter, and they're doing, in terms of in their business, then we would ask in terms of it's a bit more questions of were people just giving in terms of money, or what was kind of essentially, was there some sort of reward or other enticement? Okay? Ruth?
On the recipient issues, let's say that you're going to have a heart transplant, okay? And you raise more than the cost of a heart transplant.
Yeah, windfall.
And do we have some issues there? And a B, is it going to be a deductible medical expense? You really have the choice of how to spend the money you received. So do we have that?
Yeah, I think those are all, extremely important and timely issues that have not been answered. Because, like, for example, we never thought of profiting off of a gift, right? Gifts always mean kind of a one-to-one correlation. But in the world of crowdfunding, I can actually receive gifts and make a profit, number one, to answer your question. Because, for example, what's the most common example of a windfall is an inheritance. And under our current rules of taxation, we don't tax beneficiaries, we tax estates. So I can, because of my heredity, my genealogy, inherit $1 million, right? $100 million. Or I could be born into poverty. But we never tax that to those who received it. And that's an interesting question in the 21st century, is that I, as a random person, can need $50,000 but raise $250,000 and bank the money. Should that be taxable? There's no legislation. That's not the law. So under current interpretation, it would fit in the whole, well, a gift, and it doesn't matter in terms of the amount. And then in terms of in the other issue, when we get of deduction, we use the other analogous situations isn't the basis of the donor, equivalent transfer to the donee? So like when we donate stocks, the basis of the donor is equal to the donee, so I take those attributes, so therefore cash is cash, so cash is to me, therefore I would get the medical deduction. Because the gift didn't go from Ruth to Children's Hospital, it went to William Rogers. William Rogers cut the check to Children's Hospital. And under our current law, that would be a Schedule A, unless adjudicated, right? In the back?
But isn't it, if it is a instance where you're gifting money, isn't that kind of slippery slope? Just because you given your intent to use this money, if without having given your intent, if I gift to Ruth $14,000, she doesn't, you would not have to claim that as income. If Ruth told me I have this need and I gift her that same $14,000, but she told me the need is $10,000, I don't see the mindset that then would say that extra $4,000 now, because you stated your intent, becomes something that's taxable.
Well, under our current law, let's use the more better term, mooching, okay? And in terms of people who support their kids, right? And they just kind of give them money. Was that ever income to the kids? It's all in that wash, right? And some parents are so generous that that's a lot of money. But it was always gift. In today's world of social media and technology, we can gift to strangers and that money can add up and multiply and compound. And as Ruth is identified and as you're seeing here, we're trying to take the world that we see under gift and estate tax rules, and we see an inherent unfairness when we put on the lens of income taxation. But our tax code looks at things differently. Under estate and gift taxation, gifts were never taxable to the other party. We always gift on those who gave the money. We never tax those who received the money. Whether it was an issue of it's fair, it's moral, like for example, the parent who gifts the Ferrari, the parent who gifts, a stipend of $5,000 a month that I call reverse form of welfare to never work. We never taxed that, even though it may seem immoral. That's just how tax law works. But that requires legislation to now determine as we may have a situation of what we call a loophole that people can create what we call a disguised for-profit. That's not truly what we call charitable. Doesn't exist at the current moment. And that's what you're seeing is the distinction between tax law and innovation and trying to keep up.
Because there are pages that have been set up just out of kindness. Maybe you've seen somebody that was mistreated. I think there was one set up once for a bus driver that somehow was mistreated and got hundreds of thousands of dollars.
Correct.
That was all people gifting out of generosity.
Correct.
But if we start taxing that, then doesn't that bring into taxing any kind of gifting that gets done though? Or do you have to have a relationship?
Well, certain gifts are taxable. So the most common example, swag. There was always a lot of, hem-haw over when we see the Oscars in Hollywood that would get valuable swag. And I have clients in their businesses is because of sales, they get all kinds of what we call perks. Trips to the Caribbean, they may get a new car. Those are all taxable goods. But they're not given out of, in terms of what we call the act of detached generosity, because there's a quid pro quo behind it. You met sales goals. You scratch our back, we scratch yours, type of thing. And that's why that they were always, in terms of taxable, and like in the Hollywood case, is that's not charitable people who won the Oscar and then they got a nice, swag bag, and that has economic value.
Those are also from a business.
Huh?
Those are also from a business, not an individual.
But businesses can give gifts too.
$25.
Huh? No, to be deductible on their return.
Right.
A business can give an unlimited amount of money, it just can't be deductible. $25 per gift is what we deduct on income tax purposes, but businesses can just say, hey, I just cut a check. Yeah.
Right. But then thus it's not being deducted, so income tax is being paid on it by the business or their shareholders because it wasn't deducted.
Well, that's an income tax issue. But again, the rules, as we're talking about in the world of estate and gift tax, was always meant for individuals. Okay? But again, people who are receiving in the gifts and how these can be large sums of money, we didn't ever really tax people who received gifts. Okay? And in the business context that you're talking about, most of these gifts are in regards of an exchange of some sort of service. Something was done and performed. But the case of a gift of a business giving money out of the kindness of its heart, we just cut a check. They can cut a check like anyone else. It's just there's a question of, is it deductible for the business?
You can even take it the same way personally too. The person that's writing that check, they're not getting the tax deduction for it.
Correct.
Same as
Unless it's an actual
So why should
501c3.
the recipient being paid tax? Because it's still being, tax is still being paid, one way or the other.
Right.
Same if it's business or individual.
But the point that we're bringing up in this discussion is we are in a world where there can't be a profitable gift for a recipient. And we just are in one of those kind of gray areas that hasn't been determined. Okay? So, essentially the takeaway is that what the IRS Chief Counsel is basically stating in their memorandum is that a voluntary transfer without quid pro quo isn't quite definitively a gift for federal income tax purposes. What they're essentially just stating is that they may contest it. Okay? And so going back to essentially what Ruth was pointing out, they may contest that is truly a gift. It might be what we call a disguise. And what's the term that's usually used in tax? It's called substance over form. And substance over form is the overarching principle, is that people, taxpayers, can concoct very elaborate devices or ways to perform a transaction. And we have to look at the overall substance of it versus the form. And is it really just an elegant scheme to avoid tax? And that's often how it comes down to in terms of being adjudicated. Okay? Okay. So let's talk about, if there aren't any questions in terms of on that, let's start highlighting and doing business abroad. So now, as we've spent for the latter part talking for much of the time within the United States, now as we're becoming transnational, we have to start, understanding, examining some of the elements of tax treaties. So tax treaties are basically what we call bilateral treaties that are negotiated between two separate countries. And the whole purpose is to mitigate the effects of double taxation. Two is to establish some sort of a rule, a threshold of when a taxpayer is subject to tax, vice versa. Okay? The nexus issue, what we talked about. Because a lot of, as we were exploring earlier today in the states, when you allow states to create their rules, it creates confusion. It doesn't enhance compliance because you may get people who will hunker down because of the cost. the confusion, the complexity. So tax treaties are meant to mitigate some of these issues and come to an agreement, a consensus. And then finally, the third principle, third prong, is to come up with an agreed upon withholding rate or regimen for different types of income. Okay? So, in the context of global taxation, we usually refer to two types of taxes: direct taxes and indirect taxes. Direct taxes are just income taxes. Means that they're sourced directly to income and revenues. Indirect taxes are usually what we think of in our mind, what we're used to in the U.S. as sales taxes, excise taxes. Most of the world doesn't use sales tax, they use VAT taxes. Those are all called indirect taxes. Tax treaties, just so that you know, only address the issue of direct taxes, income taxes. They do not address this issue of indirect taxes. I get quite a few Canadian taxpayers and others who are getting hit from Form 720 U.S. excise taxes because they keep on trying to refer to the U.S.-Canadian tax treaty, and you have to explain to them that's for income taxes and not on excise taxes. And vice versa. We're the United States and selling and operating into Canada. Okay? Indirect taxes are those that are usually addressed directly by those domestic authorities through their own legislation. So in our legislation, we legislate excise tax on those who import, goods and vehicles and those items into the U.S. for sale. So in the world of tax treaties, we don't use the word nexus. We use the word permanent establishment. Okay? Permanent establishment is synonymous for nexus. The primary difference between nexus and permanent establishment, because nexus usually is a term used by states. Permanent establishment is a term used by countries, is that most of the rules worldwide right now tends to refer to permanent establishment in a more physical, tangible nature. The old-fashioned nexus that we're accustomed to. Okay? They have kind of yet to keep up, even though here domestically, our states are trying to evolve rapidly with all these forms of virtual commerce in terms of their definitions of nexus. The permanent establishment, once it is established, is used to essentially allocate those rights of taxation on the income. Basically, to what country are those profits attributed to? So, as I talked about in the prior segment about the bookkeeping firm who's here in Arizona contracting those bookkeepers in Shanghai, the question is, does that bookkeeping service in Shanghai have a permanent establishment here in the United States? No, they do not. So they don't have income taxes in the United States. And what is a permanent establishment? So we usually use a two-pronged test. And the first prong is whether the business has a fixed place of business within the country. An office, a warehouse, a branch, factory, workshop, and when you're in kind of, oil and mining, that you've got a well, quarry, some other kind of site where you're extracting natural resources. It's fairly straightforward and relatively black and white, believe it or not, in terms of what actually is a fixed place of business, okay? Then we've got the other issue, because in international business, most businesses are operating in another country via what we call agents. They're not actually there forming an entity. They're not actually setting up shop and offices themselves, people on their own payroll. They're usually contracting through some sort of third party. So then the question is, at what point does a dependent agent become a permanent establishment. So having an agent that's independent and acting in their course of business is not necessarily what we call a dependent agent. So let's use that bookkeeping example, the one in Shanghai. That Shanghai firm may solicit all of us here and work for lots of accountants. And this is what they do, is their business. Give us your bookkeeping, we're much cheaper, we'll do bookkeeping, we'll do taxes. A dependent agent is one who's just working for you. Just only you. They don't have anybody else. Okay? And so, in a way, that is like a quasi-employee. And thus it is viewed as though, well, that person is dependent upon you. They're not out operating in the ordinary course. They don't have business cards. They don't have they're advertising under you and your umbrella, so thus it's a permanent establishment. Okay? And so then if that's the case, if it's deemed that you have a permanent establishment, then you must be filing taxes in that country. Okay? Plain and simple. So when we look in terms of the test, we look in terms of from an economic and legal independence test standard to determine if they're actually, a dependent agent or not, in that regard. Any question in terms of on dependent agents? This is the most common area because I see this a lot in terms of in businesses. They'll say, we're going to be setting up in Canada and we want to start selling our product, but we have a rep out there in British Columbia who's going to go out and, promote our products. So when you ask in terms of in a rep, do they do this for other businesses? No, they're just doing it for us. You see what I'm saying? They're essentially kind of working for you, advertising under you, promoting under your business card, promoting in terms of your website. There is no independence there. Okay? Even though they might be operating from home. So a virtual permanent establishment is kind of a new and emerging concept. It's not something that has been what we call legislated yet or determined. It is an area of interest. So when we talk about in a global setting, we have what's called the Organization for Economic Cooperation in Developing Countries, the OECD. And they talk about a lot of hot button issues of affecting amongst the members there. And obviously, tax avoidance is one of the primary issues that they're trying to address. Because essentially in a global world, it's very easy for businesses to set up in what we call tax havens to sell worldwide and not pay anybody taxes. Okay? And so this is one of their primary issues of getting together. How do we combat this? Because they're all facing this inherent issue of in a global world we have an eroding tax base. So one of the issues that's coming up, what we call emerging, is discussion that's early on that we haven't seen yet, but I call it coming soon, in terms of the concept of a virtual permanent establishment. And so the virtual permanent establishment is meant to address the idea of digital commerce. So let's take the classic example. Who here likes to use Netflix? A good portion of you. I miss Blockbuster. I really did. I enjoyed going to Blockbuster when the new movie came out and there was nothing to do on Saturday night, and you rented it and you stuck it in the VCR, right? I love those days. My kids, they want to just watch Netflix. Netflix can operate anywhere, right? Netflix can set up in Ireland, they can set up in the Cayman Islands, and they can have customers anywhere. And this is a challenge that you can have $1 billion enterprise who's got millions of customers who are your citizens not paying a dime of taxes online gambling, online poker, all these different types of businesses. And that's the challenge that we have, because as we were talking about early on with the permanent establishment, that was meant for the traditional economy, the Blockbusters of the world. The Sears Roebuck. It wasn't meant for Netflix and those companies that could be set up worldwide, FanDuel, and all those emerging sites that are becoming these multi-billion-dollar players out there. And so this is the initiative that the OECD is working on. It's called the Base Erosion and Profit Shifting Initiative. And this is one of kind of their hot button issues that they've kind of adopted as what is a draft proposal. It's an idea. And the reason why I share these, what's important in these topics, is for us to see as kind of what we call the trend and things to come in terms of new and future legislation. And so one of the hot button issues that they've addressed is how do we kind of evolve this idea of a permanent establishment? And so in terms of in this working draft, they've worked in terms of creating a definition of creating a virtual permanent establishment. And again, what I want to emphasize, it's just a working draft and it is yet to be adopted in terms of that point. And so I'm just going to pull up in terms of for your reference, because I think that it's quite important. So let's turn to page 44. So in terms of in the takeaway here on the bottom paragraph of page 44, it's basically under the proposal is a company engaged in certain fully dematerialized digital activities. Just substitute that for Netflix. Okay? Would have a permanent establishment if it maintained a significant digital presence. So let's forget about the United States. Let's go to Brazil. Large population. Let's say they have 10 million Netflix subscribers. That's the point. It's not we're talking 100 people or 1,000. You have a significant customer base. And that's what they're trying to address in terms of you having a permanent establishment. So some of the elements that they're describing in that is basically the core business of the enterprise relies completely on a considerable part of digital goods or digital services. This is Netflix's entire business model. This is iTunes, Spotify, FanDuel, Hulu, over and over and over again. Okay? And believe it or not, there's going to be a growing trend as we get more into accounting and bookkeeping that might happen virtually out there in terms of in an automated world. No physical elements or activities are involved in the value chain. So when we talk about a value chain, we have to break down what it takes to provide that good or service. If I make shoes, I need to get leather, I need to get soles, I need to get laces. We have different parts of the chain. When we're doing in terms of in our services, I have to get documents, I have software, I have tax preparers, I have a review. We have different elements of the chain. But as you see in the digital world, that chain is essentially compressing that Netflix isn't Disney. They're not shooting and producing. They're just streaming an actual show. Okay? And so that's basically those chain of activities are more and more going away. Thus, it's occurring virtually. And it's more important as we talk about in a world of artificial intelligence and automation is now we're taking the people behind it away and the machine is creating it. Create the show, create the movie, create the game, create the app. Okay? And so this is what it's trying to address. So therefore, if we had a totally automated type of business, we need to shift the taxation to who they're serving, the customer base. Does that make sense? You see how we were talking about early on in some of those sales tax, how essentially evolving worldwide, that's eventually gravitating towards we have to shift our taxation to who's the market or customers being served. And that's where the tax event occurs. Okay? And that is in terms of the key trend at the moment. Any questions? Okay, so we're going to take a 15-minute break.
Yeah, it's time for break again.
Okay.
We got one more session after this break, and then we'll have our lunch and installation at 1 o'clock. Just another point about tomorrow, we're going to be at the Lone Butte Casino. It's at 1077 South Kyrene Road, Chandler. That's the actual physical address if you want to put it in your phone. 1077 South Kyrene Road. It's at the southeast corner of Kyrene and the 202. Just wanted to ask for a count. There's a possibility we could get a shuttle from people that are staying at the hotel here. We could shuttle from here over to there. Is anybody interested in the shuttle? 1, 2, 3, 4, 5, 6. Okay. We'll get with David on that. We'll get back to you about the shuttle.